Hello again, and thanks for pushing play, and welcome to 2018. So it's that time of the year when many people think about their goals, dreams and aspirations, and for some, owning their first home is on the list. Now that particular goal will require a lot of patience, perseverance and determination as you save for your first home deposit, find the right property and navigate the home loan market. In May 2017, the federal government announced some assistance for those wishing to save for their first home in the form of the First Home Super Saver Scheme. This scheme allows you to make voluntary contributions into your superannuation fund and then eventually withdraw those funds with earnings to make the purchase of your first home, provided that happens after the 1st of July 2018. So what are the benefits of using the First Home Super Saver Scheme over saving in a traditional way for your first home deposit? Well, the first thing is that the contributions to super may be able to be made before tax. That is, there'll be concessional contributions that may be made via salary sacrifice arrangement or even claiming tax deductions for your super contributions in your tax return at the end of the year. So therefore, that has the potential to save you tax and maybe allow you to contribute a little bit extra than you thought you could. The second benefit is that upon withdrawal, you'll be entitled to the earnings on those funds, and that earnings rate is the 90-day bank bill rate plus 3%, or otherwise known as the ATO's shortfall interest charge. Now, in many cases, well, for example, right now in the March 2018 quarter, that rate is 4.72%. So in many cases, that earnings rate may be higher than what you can receive on a traditional bank account from a financial institution. So of course, there are terms and conditions surrounding this scheme, and basically you have to make sure that you're making your contributions to a super fund that will accept the contributions, but most importantly, it's still subject to your superannuation cap. So for 2017-18, that amount is $25,000 per year. So you don't want to exceed that. So before you make a decision on how much you can contribute to super for the purposes of saving for your first home, you need to know how much is currently going into super or will go into super for you from your employer or any existing contribution schemes. The second thing is that you will pay tax when you withdraw the money from the super fund to use for your first home deposit. However, the tax office will give you a 30% tax offset. So therefore, many may not pay, or may pay very little, if any, tax upon withdrawal, depending on your income in the year that you make that withdrawal. So obviously this is all general advice, and it's really important that you get personal advice tailored to your specific circumstances. Call our professional team at Southerton's Gladstone on 4972 1300. We'd be happy to assist you with your goal of home ownership. Thanks again for pressing play.